You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Thanks for tuning into this week's episode of the Tax Smart REI Podcast. Today we're joined with Austin Dean of Waystone Advisors, who are actually real estate friendly financial advisors. I know those are hard to find in today's world, but here we are today. We're going to be diving into financial planning for real estate investors and people who invest in alternative assets. Thanks for joining us today. Would you be able to give our listeners just a brief overview of your background and how you got involved in the financial planning space, specifically for real estate investors?
Yeah, absolutely. It's good to be here. As far as background, so I did start out, it's over 13 years ago at this point, in the financial planning world. Spent the first couple of years starting my own business. I got the traditional route. I got a certified financial planner designation, a few other ones that people don't necessarily know, including a RICP, which stands for Retirement Income Certified Professional. And what happened with me being in my early 20s at the time, I very quickly realized that the traditional method of saving a bunch into retirement accounts, hoping the market grows over the next 10, 20, 30, 40 years, and hoping I have enough money when I'm 60 plus, wasn't necessarily the route that I wanted for myself. And as a result, I started looking around and saying, what are other ways? What are other ways to build wealth? And things that I imagine you guys have concluded, but I found in my research that the most wealthy tend to be people that build businesses, that buy real estate, that understand how to use debt as a tool. Obviously, there's risks to that, but knowing how to make your money work harder and not necessarily trap it into places where it's only doing one thing for you. So as I was building that kind of ideology and that framework of a more non-traditional approach to financial planning, I ended up connecting with a couple of new clients that had 3, 4, 5 different single-family properties. They said, "Hey, we're looking for an advisor who can help us build money in places that can help us do more real estate, not less." And that gave me all the permission I needed to start really building out that framework of, how do lines of credit work and how do we use investment accounts in a way that's complementary to financial independence, and how does life insurance actually work? And over time, part of why we're here is because it turns out that idea of having financial flexibility without having to wait till 60 is a really attractive one, not just for people in their 20s, but anybody looking to build wealth and have more control over their finances.
Makes a lot of sense. And I know a lot of financial planners that we've spoken to, or clients have spoken to over the years, tend to shy away from real estate. I know you mentioned you had, some clients who had some rentals that kind of put you onto the space perhaps and kind of digging in. But what made you want to be in real estate as opposed to just going the route of all the other financial advisors who kind of just stick to their stocks and bonds and traditional assets, for lack of a better word?
Yeah. What I found with real estate was that when done correctly, there's a variety of different ways to build wealth with that. Whether that's you can be the lender and you can make money by lending to people doing real estate. You can go flip, which obviously has its own very unique versions of risks. You could do syndications, real estate, and those come with tax benefits and ways to force appreciation, and perhaps most importantly, the ability to eventually create cash flow. And cash flow is inevitably what creates the ability to replace your need to work and creates more of that financial flexibility. And traditional market assets don't have the ability to create cash flow in the same way, nor have the ability to create those same tax benefits. Which doesn't mean somebody should only do real estate. We want to have a comprehensive, diversified plan. But I came to realize that it's a mistake to not think about the benefits of real estate when incorporated well into somebody's unique plan.
Right. I know you're not like a real estate purist. You do believe in having other assets, some of those traditional assets. So how does this all kind of come together in your overall investment philosophy? How do you look at the puzzle of just investing overall?
Yeah. We've created a few filters, and the first one is everybody's unique situation has their own goals. So any financial planning decision should be made based off of us helping really develop and understanding somebody's goals. Somebody who wants to have maximum cash flow as soon as possible is going to invest differently than somebody who wants maximum net worth in the next 5-10 years, right? And working with real estate investors, a lot of doctors, tech employees, we find that people that really love their jobs, they might say, "Hey, we just want to make our money work harder." And some people say, we have doctors, someone talking to you right now that are feeling burnt out. They say, "Hey, we want to feel not trapped in our job yesterday." So having that filter of what are we trying to accomplish? But then from there, philosophically, I'm a really big fan of saying, what's going to create the most flexibility, the most control, the most leverageability? And leverageability, not just in the sense of adding debt, but just making my money do more than one thing at the same time. And then if we're taking that lens of somebody's goals, looking at what's the most flexible option to do the most with our money, that then leads to things like, if we're looking at retirement accounts, I don't want to sound anti-retirement account, but to an extent, I am that weird financial planner, and our team as a whole that is a little bit anti putting more money without getting free money from like an employer match into a retirement account, because that's money that is only doing one thing. Where if we have money in a brokerage account or we have money in a life insurance policy, we have the ability to leverage that or deploy it without having age restrictions or penalties, and potentially use those as some of the funding vehicles for things like real estate or private lending or other alternatives that make your money do more for you. To bring it all together a little bit, so a few years ago, I created this idea of what I call the 3 pillars of wealth design or financial independence, with the idea of saying, hey, if we have money that is stable, so non-market based, that's not going to fluctuate the market. We have market-based assets that have the upside potential, but ideally have the benefit of being flexible and leverageable. And we pair those with assets that are creating income or tax benefits, things like real estate, and we merge those together. We're going to have the diversification to have our money be doing several things at the same time. And if we're doing it with the lens of flexibility control, we can design it to not necessarily have the same age restrictions or penalties that somebody might have if they went a traditional route.
So you mentioned earlier, you said use the phrase leverage these investments and leverage these assets. And as a real estate person, I always catch that. I'm thinking, yeah, because we're as real estate investors, we're very attuned to using leverage, using other people's money. But it sounds like that's a little bit different. Do you want to expand a little bit more on what you mean by that? Because I think that most investors aren't probably thinking about that as much, about how they can use these other types of investments, retirement accounts, things like that, to leverage additional investments in real estate, if that's what you were talking about.
Absolutely. And leverage could have a few different meanings. And I'd like to take a second to say that any kind of debt or any kind of leveraging type tool has its own very unique risks that should be done ideally under the guidance of professionals. That's part of why we have a job, because we want to make sure people are actually using these tools safely. But there are so many different ways, many of which people don't know about, to be able to use debt or even just to have your money work a little bit harder for you. Ones that I know that Thomas and Justin and we've talked about before, this idea of, if somebody has money in a retirement account, what if they instead built that money up in a non-retirement account? That upfront sounds like it'd be potentially less tax efficient because we're not deferring those taxes into the future. But we have the access to resources like a securities-backed line of credit, which when done well, you can access anywhere from 30 to 75% of an investment account, which once again should be done safely and with ideally some professional guidance. But if I can have my money invested in the market and it's growing at, you have 6 to 10% over time, and I can borrow, 50% or more of that and put that into real estate or something else. And you guys can speak to this more, but potentially create tax deductions on, if there's interest that's being used for investment related purposes. Now our money is actually working in 2 places at once. It's creating some more flexibility, some potential tax deductions, and allowing your money to go further than it would have gone if we just put it in one place and set it and forget it.
And so what you were saying there is talking about the growth in that account, but then also being able to basically borrow against it to invest in other assets. I want to clarify for everybody listening, are we talking about, this would be different than with the idea of taking a loan from a 401k where you're literally taking money out of that account, right? But what you're talking about sounds more like, no, leaving it in that account, it can still attain 100% of its growth, right? Like in that brokerage account that it's aiming to achieve. But it's just effectively using it as collateral. Is that the best way to say it, to where you're still making those investments in both places and you're not necessarily draining the value of the other asset? Is that kind of one of the advantages to highlight there?
Yes, that's a really good distinction. And for real estate investors who are thinking of maybe a comparison, something like a home equity line of credit, right, allows you to borrow against your asset without liquidating and reducing the value of your home, right? A securities-backed line of credit is a similar way to do that with an investment account, where all of your money stays in the account, it continues to grow, and you can borrow against it to do something else. And once again, to your point, this is a conversation I have with a lot of clients who have large 401ks. With a 401k loan, it's nice that you have the ability to access it, but it is something where when you pull it out, there's a maximum, that $50,000, and it's money that's actually pulled out. So it's not doing 2 things, it's just doing one thing. And then with the downside of you're repaying after-tax money back into a tax-deferred shelter typically, So we actually, when talking to real estate investors, we'll oftentimes say like 401k is a good last resort, but it's not as attractive as it sounds before you dive into the actual how it works.
Okay, that makes sense.
Yeah.
Yeah. Before we dive into, like, I know we want to touch on some life insurance stuff. Before we dive into that, say you have an investor, maybe they have a job or maybe they have a business, they're doing real estate on the side. What do you think their portfolio should look like? I know sometimes they should also have some traditional assets like stocks in their portfolio. Do you have like a typical like allocation that you see? I know everybody's different. Everybody's financial situations and goals are a little bit different. But have you found any like optimal allocation, or like is there a general recommendation or general theory that you have on how someone should allocate their portfolio?
Yeah, that's a great question. I found over time that I don't actually have a default allocation specifically for how, like, what percentage of somebody's wealth should be in stocks versus in life insurance or real estate or business. And that goes back to, for me, more of a what are their goals, right? And if financial independence is kind of that inevitable goal, that typically starts with saying, hey, what kind of cash flow are we looking for? Shoot for a long-term cash flow perspective that backs us into, okay, what are the assets that are going to allow us to get there and do it the most effectively with the most amount of liquidity and safety. So that's where, instead of saying, hey, you should have X percentage in the stock market, X meant, in life insurance and real estate and business, I more say, hey, when you have extra, let's make sure that we have know where it should be going. So if the goal is more flexibility, more cash flow, that's where we look at, say, we want to have, we want to have emergency reserves. We always want to have that protection for the what ifs. That allows us to be more intentional with our other assets. But if we prioritize things like non-retirement investment accounts or life insurance, things that are growing, but that we can borrow against or access without penalties whenever we want to then go, invest back into that business or invest into that real estate, investment that's going to create the cash flow for the financial independence we're building towards. That's more of how I prioritize it, of saying, hey, we should have these things because those things, by these things, I mean, when possible, money in investment accounts and money in, life insurance, because they are going to grow differently than having just money in real estate or just in our business. But they're also going to, if done well, give us another tool for being more nimble with how we build our business or acquire real estate. Does that make sense, Tom? Am I explaining that in a way that makes sense?
Yeah, no, it makes a lot of sense. I guess it just comes down to, at the end of the day, what are your goals? Where are you in your, business and investing journey? And kind of from there, the allocation is going to vary depending on those factors.
Exactly. If we're prioritizing, flexibility, control, and cash flow, and multiple uses of our money, that creates a really easy filter for deciding where we put our money, given some unique situation.
Makes a lot of sense. Moving into life insurance a little bit, I know some people believe in life insurance is just for its intended purpose, which is, estate planning. For example, covering certain maybe estate taxes or providing for your loved ones when you're no longer here. What is your take on life insurance, and how do you use it to help people to build wealth and also to protect themselves for the inevitable?
Yeah. My take first and foremost on life insurance is that when a life insurance really became a thing in the last 150 years or so in the US, it started out as something that was designed for the wealthy and sophisticated to be able to grow and pass money on tax favorably. And as a result, there's a lot of levers, if you will, that you can use to design it well or design it poorly. So I'd say first and foremost, you want to have an advisor who, if you're going to do life insurance, knows how it works so they can design it properly so you're not paying unnecessary expenses, so you're using the right company. Because from a risk perspective, I see one of the bigger risks with a product like a life insurance that has the potential to actually have some tax breaks and have some potential for guarantees in some ways. The risk is not doing it right. So not funding it properly, not designing it for your situation, paying unnecessary fees. But when done well, honestly, it's one of my favorite vehicles because it is something that doesn't have age restrictions if done properly. It has the ability to grow tax-free. Depending on the type of permanent life insurance, there's a few different types. For real estate investors, I tend to be more of a fan of a well-designed whole life policy because banks will view it like cash. Something we'll educate our clients on, and this is connected to this, is how much a bank will lend against an asset tells you how safe or how risky that asset is, which goes into real estate and stocks and those kinds of things. Well-designed whole life policy, you can borrow up to 95 cents on the dollar. They'll lend on it like cash.
Wow.
So in a position where if it's designed well, it's with a company that's growing. My policies personally are growing somewhere in the mid 5s tax-free, which, I mean, you guys can validate this from a after-tax basis. I'd have to be making 8% plus in a savings account to do what my life insurance is doing tax-free, right? But then being able to borrow it at rates that are, even right now, I mean, high fives, low sixes. But then if I can deduct that, I actually end up being able to have money growing inside my life insurance, have a death benefit that allows me to, if something were to happen to me, my business, my clients are taken care of, my family's taken care of. And if, everything goes the way I planned, which is living a long time, after tax deductions, I'm actually making 1% to 2% still on that money, even after borrowing it out almost dollar for dollar, which, as you can imagine, really helps make your money go further.
Just to follow up on that, it kind of sounds like the way you kind of look at life insurance is not only for the death benefit to cover things when you pass away and your heirs need to take care of that stuff, whatever the case is, but you also look at it as a tool to build wealth and borrow against during your lifetime, kind of similar to like the stock portfolio or the real estate portfolio. You have all these assets that are growing in value, and then you just take loans out against them, so you're using the same dollar more than once.
Exactly. Once again, like you borrowing against anything, even something as secure and safe as a life insurance policy is, there's risk. You got to know how to do it right and have some guidance around it. But I'd even go back to what I was saying before about leverage. Like, leverage isn't exclusively around debt. It's also just around how many things is my dollar doing for me. So in a well-designed life insurance policy, I'm going to keep saying well-designed because there's so many that are not. So there's a reason the internet thinks that the life insurance is either the best investment ever or a scam. It's because it can be designed to be either of those if it's not, by somebody who doesn't know what they're doing or somebody who does. But a good life insurance policy, right? It'll protect your family right now. So that if you pass away, your plan and your family's taken care of. It'll build your money tax-free. It'll give you access. So it can be extended emergency reserves. It can replace the ability to have bonds because it's not market-based. I mean, even on the traditional financial planning side, my RICP designation talks about the value of having a volatility buffer, something that when the market goes up and down, just slowly goes up so that you can navigate the inevitable ups and downs of the stock market or the real estate market. And then to what you've mentioned a few times, Thomas, permanent life insurance policy is a fantastic way to create some default estate planning so that you can pass on an asset that's liquid to help buy out the government so that you can pass on your real estate or your other assets that you want to go to your kids or to the heirs that you want them to go to. So I'll just say it's once again just from a pure financial planning value of how do I make my money do the most things for me? Life insurance, when done well, does a good job of having a multiplication effect of what it's doing for you.
With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode.
How do you kind of determine who might be a good fit for the permanent life insurance versus like just the term life insurance? Do you have like a really clear distinction of like who fits into those buckets, or is it kind of, again, based on goals and I don't know, some other things there? But maybe you could just talk a little bit about that.
Yeah, I mean, that's a great question, right? I mean, the easy answer, I guess, is to say yes, it comes down to goals and what they're trying to build. But I'd say going a little deeper than that, I mean, somebody who is younger, doesn't make as much money, maybe has some young kids, and they're trying to just start something, oftentimes it makes more sense to just have some default protection to protect the plan. Because life insurance ideally is something where, I mean, like you want to be able to commit to funding at a fairly high level for several years. The first policies I ever got are, I can fund it a couple $100 a month, but I'd say they're not as efficient as the ones that, if a client funds it at, 20,000 or more a year. Those become a lot more efficient from an internal rate of return, growth rate, those things, and fit better into a broader plan. So all to say is term tends to make sense, I think, when there's a larger protection need and people are in the early stage. But as somebody makes more money and have more flexibility, particularly if they're trying to do real estate or create financial flexibility early. That's when it starts to make sense to look at, could a permanent life insurance policy fit a spot into that plan?
That makes a lot of sense. So the permanent life insurance isn't for everybody or all situations per se, but like say someone comes to you, they're building wealth, they're in that building wealth phase. How much so you say the importance of life insurances and saying doing like a whole life policy, something they can borrow against versus using that money to build their portfolio, whether that be stocks or real estate. I always found that an intriguing question. Like, okay, everybody has limited assets. Even if you are making a good amount of money, how do I know if that dollar is at this stage of my life worth putting into funding a life insurance policy versus taking that, say that $20,000 per year and putting it into the stock market or putting it towards down payment on a property? Like, how does that kind of work, or how do you look at that?
Yeah, it's a good question. When thinking about where to put money, that goes back a little bit to me of what's the highest rate of which we can duplicate those dollars. So something like a life insurance policy, if it's designed well and somebody's healthy enough to qualify for it, how we typically design it, somebody even in year one can access usually 70% or even a little bit more of what their contributions are right away. And every year, because the expenses with a life insurance policy tend to be a little bit more upfront, kind of like the down payment of a house, where they're not as recurring. The longer you have it, the more that money actually just goes towards building wealth. Someone who says, you know what, I would like to put money into a down payment on my first rental property, and I expect to continue to have $20,000 or more a year that I could be putting into a life insurance policy as cash flow. I would say, let's consider doing that, because the younger you are, the better the health rating typically, the more death benefit you'll get per dollar of expenses. And if we can borrow that money back out at 70% right away, and by right away, I mean usually within the first 30 to 60 days, we can get that money back out if we need to. That allows us to say, hey, we built it, we set up this asset, and we're still able to use it for that down payment on that real estate property that I want. And I'm positioning myself to be able to do that more and more effectively in the years to come. My default thoughts on that, with once you kind of ad nauseum, it depends on somebody's goals and situation.
I'm curious, I want to ask you this too, is like you mentioned before, we're talking about banks and using something like insurance to that, being able to lend against it much like higher percentages because it's so close to cash, or viewed sometimes so close to cash.
Yeah.
Do you see very often, when I think of a lot of, and again, some lenders are different than others, but more traditional ones a lot of times don't like it when say like a down payment for a property is coming from like another source of debt. Do you guys run into that very often? Or is it that a lot of investors are using the loan based off of the life insurance to be able to purchase the property entirely? Or are a lot of them going to getting a traditional bank loan and then using this as a secondary? Is that very common?
For us, all of the above. I'd say most of our clients do more of using lines of credit backed by the life insurance or backed by an investment account as the down payment. That way their money goes further. And that's actually, a good distinction you're making, Justin, where, with a HELOC, so like with my HELOC, the downside is it's backed by an illiquid asset. So that has to report to my credit, because the only way to pay that off is with either cash flow or selling my house, right? Whereas generally, those are the lines of credit that we help our clients set up. If it's backed by a life insurance policy or backed by an investment account that are non-retirement accounts, because we can't leverage retirement accounts. The IRS has made that illegal. So non-retirement investment accounts and life insurance, because those are liquid, and in theory, somebody could liquidate that and pay it off. Those lines of credit don't actually report to your credit and don't impact your debt to income ratio. And most of the, it's not most of, all of the lenders that we use, if our clients allow us to loop those lenders in, understand that and know how to view that as essentially just a version of cash.
I guess that makes sense because they're looking at that. Oh, it's just a liquidity consideration there, right? If we're in first position, then the second loan is like this life insurance policy. At the very least, we know that they can liquidate that or tap into it to satisfy that debt, essentially, right?
Yeah, exactly. Just as an example, like my investment account, I currently have about a little over $400,000 of my own securities-backed line of credit that I've pulled out and not paid back and used for real estate or private lending or a variety of other alternative investments. But if I were to go get a loan, so I got a HELOC this past year, I refinanced to a different one to get a lower rate. And I was able, that didn't impact that process at all, because if I needed to, I could just liquidate $400,000 in my investment account and pay that off if it came to that. Now, that's not the plan, but it allows the bank to view it differently than if it was backed by an asset that was less liquid.
Yeah, I think that's interesting. We get a lot of questions from real estate investors all the time of, how is this going to impact my lendability? Whether it's taking extra deductions, is that going to hurt me because my taxable income is going to look lower on my tax return? But it's kind of interesting with this angle, this strategy. It's kind of like going in the opposite direction. In fact, it sounds like it's making you more lendable, like as compared to. I feel like, the question that would come up is like exactly what you just said. When somebody says, well, I'm going to draw my HELOC, your primary lender might look at and kind of frown upon that, if anything, because it's another form of debt. But that makes sense. It's tied to something that's so illiquid.
Yeah. And I mean, to your point earlier in terms of how it can be used, I mean, we've had clients use it as the down payment. We've had clients use it as a way to essentially be a version of buying all cash to then be able to negotiate and get a better deal, or because they're able to close faster or have it be at a lower price, and then refinance with traditional debt later, pay it off and rinse and repeat. So going back to the ability to say, hey, we want to have more flexibility and control, having something that doesn't report to your credit, that you don't actually have to use, but you can use it kind of however you need to, creates a lot more opportunities for a real estate investor than they would have without it. Once again, with some guidance on making sure they know how to do it properly and safely, because there are risks with using debt.
That's a really great point too, I know a lot of our listeners who've been listening for a few years now that went through like the 2022, 2023, real estate years. There was a lot of quick movements like that on real estate where if we're going with just a traditional loan, sometimes the sellers would get 8 offers and they'd take that all cash offer because it was so much faster. So like to that point, when somebody's using, let's say it's like and maybe this different between a securities-backed line of credit versus like the life insurance. So I can let you speak to both. But as far as like turnaround time, like if, so one of your clients calls you up and says, okay, I've got a deal. I'd like to close it in 10 days. Like, is that, how much quicker than like the traditional lending process? And I want to say like if somebody let's say they've got a securities account that has $800,000 value and they just want to pull like $500,000 to do a deal quickly. Like how much quicker can they do that compared to, going through traditional lending?
Assuming there's room on the line of credit, typically we tell clients that you can get that money 3 to 5 days, typically 3 to 5 business days. I mean, we've had instances where clients needed it like the next day, and we can escalate that. Now, obviously that's not what we want to be doing, but yeah, if somebody says, hey, we need it in 10 days and they have the room available on the line of credit against either the life insurance or the investment account, then that's a real easy ask.
Wow. Yeah, that's interesting. And then I assume a lot of people would use that. Then they take, like you said, they kind of take their time after that, after they close, just go work on doing a traditional like refinance with their favorite lending institution or whatever. And then they just come back and pay back their securities line of credit. It's kind of how they keep things moving quickly in that.
Exactly.
Right?
Exactly.
Okay.
Yeah. Yep.
Awesome.
Yeah, I got one more question on this before we move on. And this is something that I guess comes down to the underwriting of the property and how much debt the property can support. But like say, for example, you have somebody who borrows against their stock account, or they pledge their stocks, or maybe they borrow against their life insurance and they go and get traditional financing on a property. So now they have a traditional mortgage, which comes with principal payments and interest for the most part, in most cases. And now on top of this, they also have a line of credit or a loan, whatever the case is, against one of these other assets. So now they have an additional payment that they have to make. Do you see that being an issue? For example, having, for all intents and purposes, the mortgage in the first position and then this other thing in the second position. Now they have 2 payments. Do you see it being prohibitive, or is that something that most people can navigate?
I mean, I would say that ideally that's the thing that my team would help people navigate together to an extent. So I'd say in terms of how somebody can navigate that, a lot of it will come down to, in that scenario, how good is the deal? Like, is the deal cash flowing to be able to cover that mortgage and potentially cover some interest on the securities-backed lines of credit? Depending on what state you're in, and if there's room on your securities-backed line of credit, sometimes they'll let you actually take that interest and capitalize it into principal, so it doesn't actually impact cash flow, depending. Unfortunately, Washington State, where I'm in, is not one of those states, so it has to be paid in some way, shape, or form. But the benefit of that is if you pay it, in my experience, and once again, this is the kind of questions I bring to you guys, is if you pay it, it makes it easier to deduct it, though. So that also helps, right? But I'd say in that situation, though, if we assume that an interest rate on a line of credit is somewhere in the mid-60s, for instance, right? But we expect our investment account to go up by more than that over time. even if we just created a recurring distribution from that investment account to cover the interest, we would expect over the next 5, 10, 15, 20 years to come out net ahead by borrowing versus just liquidating and shifting it into one other place. So it's doing one thing instead of two things.
Got it. So there's multiple avenues you could take. You'd either pay the interest that the property can support it. So if the property is, underwritten right and it's a good deal and things like that, you might just be able to support it with the property. But I guess in a worst case scenario, so to speak, you could just liquidate part of that account to pay off the debt. And because the account's still growing at a greater rate than the interest, there's still a spread there. So it's still beneficial to do this.
Correct. And going back to that, because we know that we're doing non-traditional financial planning with a lot of the real estate and these lines of credit and those kinds of pieces, because there is risk, to your point, of having too much debt or not having enough cash flow, part of our planning process, whenever possible, is to create assets that have flexibility and multiple avenues to be able to tweak and adjust. Because, as we've seen even the past several years, you never know when interest rates are going to spike or inflation's going to go up or housing prices stall out. And we need to be able to adjust for the unknown, particularly if there's somebody who is a non-traditional investor that's doing real estate and similar things.
Got it. Makes a lot of sense. So kind of just moving over and shifting gears, where do you see CPAs and financial planners crossing over in the realm? I know we do a lot of tax advisory or how to reduce taxes and also compliance, filing those tax returns and accounting and bookkeeping. Where do you see the crossover coming in?
Yeah. There are a lot of very valuable and significant crossovers here. Even in the conversations we've had, I've pointed out a few times that I can say, hey, I think this is tax deductible, but I need someone like you guys to be able to validate that and then actually help the clients take advantage of those tax deductions. So being able to loop in and actually have a team like you guys that does tax, not just tax prep, but tax planning. So that going into the year, we can say, hey, these clients, we're planning on using these lines of credit. We're thinking about putting in these kinds of alternatives that, we believe have these kinds of deductions to get this kind of cash flow. While we can do some basic simulations on tax benefits, having a team like you guys to be able to come in and say, hey, maybe we would do it differently this way, or make sure that you're deducting in these things, or having it, invest it in this way, that allows the core strategies that we use to go a lot further and make it there. If you can save money in taxes, that stretches your dollar meaningfully farther. So having a great CPA team that's working closely with our team it's hard to not have it be a better experience for the clients.
Yeah, and I could say, on our end, we always get asked questions about asset allocation. Is this a good investment? Does this fit my portfolio? Do I need life insurance? How much life insurance do I need? Should I liquidate my retirement accounts? And while we could certainly advise on the tax elements of that, especially when it comes to like retirement accounts, for example, at the end of the day, we're not financial advisors, right? We can't tell you, hey, this investment's great for your portfolio, or no, you should allocate this percentage to stocks or bonds. You should go out and get this much life insurance. Those are things that generally are not in our wheelhouse. And one of the biggest challenges has been over the last few years is finding like financial advisors who actually like real estate in their clients' portfolios. If you go to your traditional financial advisor and say, hey, I want to allocate to real estate, they're like, okay, great. We got VNQ for you. We got some, and that's just an example, or we got some REIT for you, whatever the case is. Their first reaction is not go and buy a single family house or go invest in a syndicate or fund or go invest in this piece of real estate. It's no, keep it all in stocks and bonds is typically the answer. And obviously, a lot of our clients don't like to hear that because they're either in real estate primarily or they believe that real estate should be a significant part of their portfolio, not just REITs. So I definitely think there is crossover between the two for sure.
Yeah. To add to that, I would agree. My experience is most financial planning firms either are just not necessarily taught how to incorporate real estate outside of basic REITs and stuff like that. And this is obviously my experience anecdotally a little bit, but also regulatorily, the SEC and FINRA and those kinds of places, they put a lot of pressure on advisors in terms of how they can talk about it. And that's part of why I've mentioned, the risks a variety of times while we've been having this conversation, because real estate is, a larger asset that's illiquid, that navigates debt oftentimes and has a different risk profile. So it requires an advisory team to have a different set of knowledge and tools and process and how they analyze that. But even as we talked at the beginning, real estate just has been a proven asset over time for being able to help people who, if they can do it right and understand the risks and navigate them well, it's one of the most powerful wealth building tools out there. It's worth exploring for somebody who wants to.
For sure.
Before we move on from that, I was just going to ask, so Austin, can you guys, because we get this question, like Tom was saying, hey, should I go buy this property? Or like, I talk to people on the very front end, like, hey, can you guys advise me on like which property to buy or like which one to sell and things like that? Is that something that you guys do at all? Like, will clients try to send you like, hey, I'm going to decide between these couple of properties, which one of these should I buy? Is there anything like that you guys do, or you do guys primarily just kind of stick to like the stocks and bonds like we would traditionally think of?
Yeah. I'd say to an extent we can. So I had to caveat that a little bit of, we can't pull the trigger on buying that property. We can't say definitively like this is definitely going to work out.
Yeah.
Right. But we can, and this is because as our role being independent financial planners, so not being, I think I mentioned this earlier, but we're not connected to an insurance or investment company. It's my own company, so we have the ability to be more independent, which means that we can wear the the market-based investment hat, we can wear the life insurance independent broker hat. But I'd say first and foremost, we're stepping into these conversations as financial advisors, financial planners. So when somebody says, "Hey, I'm thinking about this deal," I think it's very much within our wheelhouse to be able to say, well, let's look at your goals. Let's look at the expectations of what this deal is going to do and say, is this going to help you achieve or get closer to where you're trying to go? And well, that won't necessarily end up in us saying, definitely do it, but it can say, hey, I don't know. That risk profile there, or that cash flow is not necessarily going to be what you want it to do. Or saying, hey, you have these lines of credit that we've set up and one of these different things that'll create the cash flow or the appreciation you're looking for. That could fit. So in that sense, we have the ability to help our clients navigate, if they bring a deal and, within the range of the data we have, we can say this does or does not align with what we know your goals to be.
You guys aren't necessarily underwriting deals and saying, oh, hey, like here's your underwriting spreadsheet. By the way, your insurance is totally underestimating that expense. Is that something you guys do? Is it just more or less, hey, great, you have your underwriting here, here's the cash flow that's expected, or here's your goals, you're looking at appreciation, like this reaches your goals or it doesn't? Is there anything deeper than that you guys look at?
Yeah, I would say, some of the members of my team on the advisory side, we have the experience that we have the ability to point out some of those things. I would say both regulatorily and from a risk perspective, I think we're going to be hesitant to get too granular with assets that we aren't necessarily managing, because we can't step out and have a fiduciary responsibility for a rental property in that sense. But if somebody says, hey, can you skim this and tell me, like, are there any things that look really off in terms of interest rate or insurance, those kinds of things, we can help with that. We also, in the same way that we have this wonderful relationship with you guys, I have independent property and casualty brokers, and we have mortgage lenders that oftentimes we'd say, hey, let's loop them in to have them also say, are these accurate? Are these assumptions that would be reasonable? So
I could see maybe just turning that a little bit is it's maybe where you'd advise like more deeply is that the client says, hey, I found a deal. I think it's a good deal. It's going to cash flow, but my goals, my plans, and all like the assets that I have, like my brokerage account, my life insurance and everything else. And maybe they come to you and say like, how should I close this? Like what they would ask you maybe like, what kind of debt should I use? And then that's where you'd have to ask a lot more questions of, well, what are we doing with this property, short-term, long-term and stuff to figure out what types of credit and what types of loans that they might want to use, like that kind of stuff. Is that maybe a little bit more applicable on how you'd like help?
That we do all the time. If somebody says, I have this deal, I feel really good about it. I'm going to buy it. What's the best way to purchase it? And then we'll have a conversation. Depending on the situation and the client relationship, that could be, let's schedule a meeting to talk about it. That could be, let's jump on a phone call for 5 minutes and talk about, which of these lines of credit do we use? And then also, what's our long-term plan for maybe repaying some of those so that we can use it again, right? So yeah, from that example, Justin, that's the thing we do all the time. And we invite our clients to do that because we want to help them be making investments that align with their goals.
Mm-hmm. I think that makes a lot of sense. And that's definitely where it kind of stops the buck for us is where, we would say, well, your tax benefits and deductions aren't going to be hugely different if you do a 20% down payment versus a 40% down payment, that sort of thing. But then it starts to wade into like, but what financially, what's the best way for me to play this with debt and stuff like that? And that's where, we always kind of stop there and say, well, that's kind of where you want to talk to your financial advisor there to kind of weigh in on that. So that's great.
Yeah. And that's where our partnership works really well, because we can tap in and say, what we think you should do it in these ways and make these adjustments.
So yeah, I know we're coming up on time here, so this will be the final question before we wrap up, and that is going to be: where can listeners learn more about you and Waystone Advisors if they're looking for a real estate friendly financial advisor?
Absolutely. The easiest way would be to go to our website, waystoneadvisors.com. On there's an inquiry form where you can submit to have a complimentary discovery conversation with one of our wealth design onboarding advisors. You can also email us at info@waystoneadvisors.com and introduce yourself and say, hey, I heard you guys on a podcast with the Hull CPA team. Can we have a conversation about what it would look like to partner together? So yeah, anybody who's interested and has appreciated the philosophical conversation we've had today would love to see if we'd be a good fit to partner long-term.
Absolutely. So go ahead and drop that into the show notes for everybody who just want to check that out. We, of course, are accepting clients as well. It's coming up on tax time. So if you don't already have a CPA or you're looking to change CPAs, now is the time to get that conversation started. If you're interested, you could go over to www.therealestatecpa.com/podcasts and you could book a free discovery call with our team. We'd love to see if we're a good fit. But that's going to be about it for today. And as always, it's important to note that there are risks associated with investing in real assets and in the real estate sector, including real estate, precious metals, and natural resources. So these can be significantly impacted by events relating to these industries. You definitely want to make sure that you're speaking to your financial advisor and your tax advisors before making investment decisions. Thanks everybody for tuning in, and we'll catch you on next week's episode of the Tax Smart REI Podcast. That's it for today.